So today's Cardinal lesson, we're talking about the you make a lot of money tax. And you say, what? Well, that's what they called it in a recent Wall Street Journal article that both Tom and I read separately. And I've had this tax as up there as one of those videos that I was going to get around to explaining this to our viewers sooner or later. Um, but it's really called the net investment income tax, or NIIT, not a commonly used term amongst just taxpayers. It's more of a tax professional thing. But my guess is that you may have paid this tax at some point in the past where you had a year with a windfall or some large amount from the sale of some real estate or some recognition of some stock options or something that drove your AGI up significantly. And you may have paid this 3.8% extra and possibly not even known it. It just, when you plug all the stuff into the software, it just adds it in to the tax preparation software. So, I just want to bring Tom on and I want him to talk a little bit about why we're doing this video.
Yeah, I mean, I think the reason we're doing this video is, like Han said, a lot of people don't even realize they're paying this tax. And so we want to first make you aware of what it is, what income counts towards it, and then what are some planning strategies, the way to minimize it. And so we'll get more into that later in the video, but we just wanted to give you some more context around this tax. And so I'm going to bring up the show notes here, and you can find these in the link below of our video. They're also on our website. But we have the board that goes through there. And then the next page, and this is really a lot of the board was pulled from this chart that we use. And this is something I have sitting on my desk. I use this daily, but it gives you some more context around what income counts, what income doesn't, how it all works. So if you want more details of what's on the board, you can look here. And then the third page is really just a blank copy of the 1040. This is your federal tax return. This is where, if you don't know what your AGI is, some people say, well, what is that? If you just pull out your tax return, it is a listed item. It's line 11 right on your 1040. So go look at that number. And this is what's driving whether or not you pay the tax. You don't pay tax on all of the income that goes into that. But once you hit the threshold, and we'll talk about that in a second, that's when you have to pay the tax. So go look at the tax return if you have some questions about that.
Okay, so what I want to do is explain the tax to you. So, the first thing is whether or not you are subject to the tax or you pay the tax is determined by your adjusted gross income, or your AGI. So if you're a single and you're under 200 grand of AGI, you're not going to pay this tax on your investment income. If you're a married couple filing jointly and you're over 250 grand or under 250 grand, you're not going to pay this tax either. So that's the threshold. But what happens is there's anything that's taxable, as you know, is going to increase your AGI. It's going to push you up to and then over the threshold. Then once you get over the threshold, then there's certain taxes that are certain types of income that are subject to the 3.8% tax. And then there's other types of income that are excluded from the 3.8% tax. So let's go through. The ones that are subject is just interest, like on a CD or a bank account or a money market account, just interest coming into you. Dividends from stock, that's income, regardless of what they're taxed at. This 3.8% gets added to it if you're over the threshold. Capital gains, the same way, as a lot of folks think that they're limited to the 15% on capital gains, but if you're over these thresholds, it's really going to be 18.8% or an additional 3.8. Annuity withdrawals. So if you put money in annuities and then you're drawing it out and it's interest and it's taxable, it's not in an IRA, it counts for this. So you want to be careful accumulating a bunch of tax deferred money in an annuity and then drawing it all out in 1 year where you're over these thresholds. You're going to pay an extra 3.8% on it. And then passive income, like real estate you don't manage, that sort of thing. any type of that income is going to be subject to the 3.8% tax. Now, what is not subject to it or excluded from it, now remember, all of these items drive your AGI, but you're not going to actually pay the 3.8% on them, is wages and self-employment. So money you get from work or from a business you own or some type of work you do. Distributions from IRAs are not subject to this. Excluded gain from a home sale, so that 250,000 per person, 500,000 for a couple amount where you're excluded from the gain from the sale of your personal residence, that doesn't count. But if you make more than those amounts and have to pay capital gains tax on that, you're going to also have to pay this thing. So municipal bond interest, proceeds from life insurance is excluded from this, and then Social Security payments. So, I mean, that's the tax. And I don't expect people to memorize all this stuff, but this is a factor when we're doing retirement planning for people that are scaring these thresholds. So now I want to bring Tom back in, and Tom's going to talk a little bit about some of the strategies that we deal with this tax.
Yeah, and before we jump into that, I do want to sort of position this in the proper way. And so, this tax, the avoiding this tax should not be the end goal of any of the planning we're doing, and it isn't for us. But when we're doing a plan and there is potential to help avoid this tax in the context of an overall plan, we'll use some of these strategies because again, our goal is to help you pay the least amount of taxes possible. But we need to keep that in context of an overall plan. But with that context, these are some of the strategies that we will utilize to help avoid some of these taxes. We'll look at the board. We'll sort of go down piece by piece. I'll give you a little bit of context over each one. But the first one is a Roth conversion. And again, when we're looking at trying to help minimize this tax, there's really two main ways we can do that. One is to keep our income or keep your income below those thresholds, the 200 for a single, the 250 for a couple, or avoid the income that's taxed at these. So if we have a high income, but none of that income is subject to this tax, then we've effectively not had to pay the 3.8%. So the Roth conversion, that is a way to avoid, you're driving up your AGI in this current year. So it's not a strategy that we're doing for this year, but we're getting money out of the IRA into a Roth IRA. When we eventually pull it out for, whatever you need in the future, it's not taxable income. So it doesn't increase your AGI above those thresholds in the future. So the Roth conversions are a way to reduce your income in the future to avoid them now, but it does cause your income in the current year to be increased. And so if you were to do a Roth conversion, maybe we don't sell an investment in the taxable account because we want to not incur the capital gain in the year we're doing the Roth conversion to offset that. So if you have questions, call us on that one. The next one on the list are IRA and 401k contributions. So if you're still working and you're able to contribute money into these accounts, those are ways to effectively reduce your income because if you put it into a traditional IRA or 401k, it lowers your AGI in that year, which if you're right on the edge of those thresholds could get you underneath the threshold and avoid that 3.8%. Tax deferred annuities. So this one's a little bit, we want to do this thoughtfully because it does help avoid taxes in the current year. And this would really be for people who are maybe still working, their income is high, their AGI is above those amounts, they have a lot of cash off to the side in savings accounts or CDs or something that are earning a lot higher interest rates now than they were a couple of years ago with the Fed raising interest rates. And that interest is being subject to this 3.8%. You could put that cash in something like a MIGA, a multi-year guaranteed annuity. We have other videos on those. The interest it's earning inside the annuity is tax deferred. So you're not having to pay tax in the year it's being earned. If you look at the left side of the board, you can see that when you eventually pull it out of that account, then now it would be subject to this tax. So we want to sort of, again, this is where the overall plan is helpful, is mirror that with taking it out in years where your income is less to avoid this tax. But if you have a lot of cash on the sidelines, it's earning interest, and you're having to pay taxes now, consider something like a deferred annuity to delay the income on those earnings. The next one on the list is qualified charitable distributions. And so this is if you're above 70 and a half, you can give to a charity directly out of your IRA. And so by doing so, it doesn't show up as taxable income in your account. It's a way to give charity, not have to pay taxes, draw down your IRA balance. And so you don't have to pay this 3.8% on, or really the doing that reduces your income, which would help avoid the 3.8% on other taxes there. And so QCDs are great ways to give. If you're already giving to different charities and you're above 70 and a half, you should absolutely be utilizing the QCDs. They are not a reason to start giving, but if you are already giving, you absolutely should be giving this way. The next one on the list is municipal bonds. Again, if you look at the left side, the interest on municipal bonds are not subject to this tax. So if you have a lot of money in bonds and it's earning interest, causing the income to be taxed at that rate, municipal bond interest isn't subject to this tax. So it would be a way to position your income in a way that's not subject to the 3.8. The next one is fixed income inside an IRA. And so this has to do with asset location. And so when you have an investment, you have a choice of where you invest that money, what type of account you're investing that money in. And so when you have fixed income and equities, it is more tax efficient to hold those fixed income holdings inside an IRA. The reason behind that is if you think of a bond, it's paying a dividend or it's earning interest. And normally, if you held that outside of the IRA, you'd have to pay taxes on that income. And that income would be subject to this 3.8%. If it's in an IRA and it's generating those dividends and interest, and a Roth IRA works the same way, you're not having to pay tax on that in the year it's earned. Now, when you pull it out, you'll have to pay ordinary income tax. But if you look over at the left side, IRA distributions are not subject to this tax. So you want those interests being earned inside tax efficient accounts like IRAs, Roth IRAs, because then when we pull it out, it's not subject to this tax. And then sort of the last one on the list is tax loss harvesting. This is where you have in a taxable investment account, you have a position that has a gain and you sell it, but you also have a position that has a loss and you sell it in the same year. You can offset gains against losses, which can cancel each other out. It's effective way to raise cash either for rebalancing the portfolio. Maybe you need money to live off of, but if you balance the gains with the losses, you don't have to pay any taxes, and again, not subject to the 3.8%. So I went through that very quickly. If you have questions about this, don't try this on your own. I mean, again, we want this in the context of an overall plan. We don't want you to focus solely on this. But again, if you have, in the context of a plan, if there is room to help minimize your taxes, we definitely want to take advantage of that.
Okay. So what we want to look at here is how does this fit into that whole plan that Tom was talking about? And today we talked about Social Security. We've talked about IRA and 401k and timing your distributions. We've talked about income and controlling your income, managing your income in such a way that you'll weave in and out of this tax. And then obviously we've talked about income taxes. So I want to bring Tom back on, and I want to tell you, we want to thank you very much for listening.
Thank you.